Imagine a world where every country is chained by invisible debts, where billions are trapped in a system they cannot escape and the few who control it profit endlessly. This isn't science fiction. It's the secret system that has been quietly shaping global finance for centuries. By the end of this video, you'll understand why nations can never seem to pay off their debts and why that might be exactly how it was designed. To understand this system, we need to go back to the origins of modern banking. For centuries, money was just a representation of value: coins, gold, and later paper notes backed by precious metals. But in the 17th century, a radical idea emerged in Europe. Banks could create money by issuing promises of repayment debt. The first major institutions to use this were central banks, starting with the Bank of England in 1694. Its mission seemed simple: lend money to governments in times of war and crisis. But there was a catch: every loan came with interest. Governments had no choice but to borrow more to pay off previous debts, and soon, debt began to compound. Fast forward to the modern era, and the same principle governs every major economy. Central banks, often privately controlled, create money as debt, loaned to governments that must pay interest. This system ensures one thing: debt is perpetual. The origins of perpetual national debt are surprisingly strategic. During the Napoleonic Wars, the British government faced enormous expenses. The Bank of England stepped in, lending vast sums, but always at interest. As historian Niall Ferguson notes, debt allowed states to wage wars they could not otherwise afford, but it also bound them to financiers. Across Europe and later America, governments noticed a pattern: borrow once, and you are forced to borrow again. The creation of the U.S. Federal Reserve in 1913 institutionalized this model. Though it was presented as a stabilizing force, its structure guaranteed that money flows into circulation primarily as loans, generating profits for banks and creating long-term obligations for taxpayers. By the 20th century, the system had evolved into a global network. After World War II, the Bretton Woods Agreement centralized global finance, pegging currencies to the U.S. dollar, which itself was backed by debt and trust rather than gold. International lending institutions like the IMF and World Bank emerged, extending the same debt-based model to nations worldwide. Here's the twist: while these institutions were presented as tools for development, in practice they created dependency. Countries that accepted loans often faced structural adjustment programs, forcing them to prioritize debt repayment over domestic needs. Debt became not just financial, it became political and social leverage. The system reached critical tension in the 1980s during the Latin American debt crisis. Countries like Mexico, Brazil, and Argentina had borrowed heavily from international banks. When global interest rates spiked, their debts became unmanageable. The result? A lost decade of growth, hyperinflation, and social unrest. But here's the shocking part: the banks profited anyway. They renegotiated debt, imposed austerity measures, and ensured that payments continued, just slower and under stricter conditions. The pattern repeated in Asia during the 1997 financial crisis and again in Europe after 2008. The system is designed to survive crises, not prevent them, and the wealthy elite always benefit. Perpetual debt has profound consequences. Nations spend more on servicing debt than on infrastructure, education, or healthcare. For example, in 2024, the United States paid over $900 billion in interest alone, more than its entire budget for science and technology combined. Meanwhile, developing nations remain trapped in cycles of borrowing, often losing sovereignty over key economic decisions. Public awareness is limited because the system is invisible. Debt is abstract, numbers on a ledger. Few understand that what seems like financial responsibility is, in many cases, an engineered trap. Over the years, there have been attempts to break free. Debt forgiveness programs, restructuring agreements, and even temporary moratoriums have been implemented. But each solution is temporary because the underlying mechanism, money created as debt, is never addressed. Even modern digital currencies and fintech innovations rarely challenge this structure. Governments still need central banks, and central banks still operate on debt creation. The game rules remain the same. Someone always profits while the masses carry the burden. Today, the system has intensified. Global debt has reached unprecedented levels, over $300 trillion in 2026. Every major economy is over 100% of its GDP in debt, and interest payments alone are a $1 trillion burden annually. The COVID-19 pandemic accelerated borrowing, and new green recovery funds are funneled through the same debt mechanisms. The pattern repeats. Crises arise, governments borrow, banks profit, and citizens absorb the consequences. The cycle is so reliable it's almost predictable. This is why economists call it the debt trap, but few people outside the financial elite fully grasp it. 1. Debt is intentional and perpetual. Modern money systems are designed to keep nations borrowing indefinitely. 2. Central banks control the game. The creation of money as debt ensures private and institutional profits at the expense of public freedom. 3. Crises are opportunities, not accidents. Each economic crisis reinforces the system, allowing debts to grow and power to concentrate. If governments cannot or will not change the way money is created, this cycle will continue. Future generations may face even higher burdens unless alternative economic models gain traction. If this video opened your eyes to the hidden forces controlling global debt, subscribe for more deep dives into the secret mechanisms shaping our financial world. Share this knowledge because understanding the system is the first step toward challenging it.